Good morning to those of you on the West Coast. Good afternoon to those of you in other parts of the country. My name is Paul Forchione, and I am going to present a one-hour talk today on volatility trading using calendar spreads and reverse calendar spreads. For those of you that are new to this form of presentation, you will have the opportunity to put whatever questions you have into the chat window, and what I will do is periodically check what's in there and respond to the questions that you have. My intention today is to share my computer screen so that you can see how I use the OptionVue software program to do volatility trading. Now, what do I mean by volatility trading? Volatility trading is a mechanism for options traders to establish positions with expectations for whether implied volatility will rise or fall as time goes on. And the positions that you can use to do this are very, very many in type, but I'm going to restrict my discussion to calendar and reverse calendar spreads. So first of all, I will share my screen with you. I will share my desktop, let's put it that way, and I will go to OptionVue. There we go. So what you are looking at right now is my quotes display, where I've got a listing of all of the various futures markets. And I am receiving real-time quotes as we are speaking, so you will see these numbers for the futures and for the options change as we go through the various screens. What I thought I would do is begin with the crude oil markets. And I'm going to pull up a matrix for the crude oil markets. And I'm sure most of you are very familiar with how OptionVue displays the futures and options quotes on the matrix screen. And I'm sure you're also aware of when you click on the price chart button in the upper left corner of the screen, what you also have here is an ability to see what the underlying, in this case crude oil, has done over the last approximately year and a half in this case, with the bar chart of historical prices, and then superimposed on that is the implied and statistical volatility chart. The blue is the implied volatility readings for crude oil options. The brown line is statistical volatility readings for movement in the underlying crude oil futures market. If you wanted to be a volatility trader, what does that really mean? Well, if I take the bar chart off and we look at the blue implied volatility line and statistical volatility line by itself, what we're really saying is there a way to establish options positions such that you can speculate on how this blue line will behave as the market unfolds, as time goes by? Is the current implied volatility reading, in other words, for crude oil, which is 24.6%, is that reading going to get higher? Is the blue line going to rise? Or is it going to go lower? Or is it pretty much going to stay the same? Well, clearly you can see there's been a lot of implied volatility movement over the last month. Approximately a month ago, we were as low as 15.6%. We got as high as 31.7% as recently as the 15th of April. And right now, the reading is in the neighborhood of 25%. So a volatility trader is going to speculate on which direction implied volatility is going to move. What I'm going to show you is a whole variety of volatility trades for different outlooks. And here's where we will begin. You'll notice that in crude oil, we have July options tied to the July futures. We also have August options tied to the August futures. We basically have options for each month and futures for each month. If we were to do the following spread, if I were to take a look at the price of the July futures, 89.26, and if I were to sell an 89, let's say 90, sell a 90 call in the month of July, that call has a 53 delta. And if at the same time we were to purchase an August 90 call, this is a calendar call spread that is at the money, very close to the money. It's a calendar call spread because we are short the front month and we are long the deferred month. That calendar call spread has certain characteristics which you can see at the bottom of the screen. The delta is approximately +2. The beta, or the positive time decay, is about $5.50. And the vega is also positive, +33. Now, what does vega mean? In OptionVue, vega represents the total dollars of impact on this spread if implied volatility changes by 1 percentage point. We just saw on the volatility chart that the current implied volatility reading was 24.6%. So if implied volatility rises by 1 percentage point to 25.6%, this vega factor is telling us that the spread will earn $33 of profit. Now, of course, if the volatility implied were to rise by 3 percentage points, then the vega factor would be multiplied by 3. 33 times 3 is basically 99. The spread would benefit by $99. This is looking at numbers. Let's look at the graphic analysis. I'll click the Analyze button, get the lines to show in red, get everything to line up here. And here's what we're looking at. We're looking at a performance graph where there are 5 performance lines. I'm clicking on them one at a time here. And the legends in the upper left corner of the graph tell us that we've got T plus 0, T plus 14, T plus 29, so on and so forth. In other words, the T plus 0 line is today's line. It tells you how this spread will behave as the market moves to the upside or the downside today. It will also tell us, if I click on the T plus 29 line, how this spread will behave 29 days, essentially 1 month from today. It will tell us how it behaves in terms of profit and loss and in terms of all of the Greek variables. So let's look at the T plus 0 line. This position right now is 1.89 deltas long. That's pretty close to delta neutral. The theta is plus 5.5. That's $5.50 of positive time decay this spread would earn in 1 day's time by the end of the trading day if all things remain the same, if the market doesn't move, if implied volatility doesn't move. And the $33 vega factor tells us how sensitive the spread is to volatility. This is a spread that a person would want to establish if he anticipated implied volatility would rise, but did not want to make any sort of a forecast for a market move to the upside or the downside. As a matter of fact, if a person had a 1-month trade horizon, this would be the performance of the trade in 29 days based upon positive time decay, building profits, and assuming that there is no change in implied volatility. However, if implied volatility were to rise, and let's say it rises by 4 percentage points, I can put that here in the upper left corner where it says volatility change, and the program will factor in 4 times the Vega factor, which is a dollar factor, into the P&L line underneath the graph. So if 29 days go by and the market is at the current level that it's at now, there will be a profit of $410 on this spread. Likewise, if the market moves somewhat higher, you can see what the profits will be at different levels. Excuse me. If the market declines in price, you can see that the profits are still there up to a certain point. But beyond 84.14 on the downside or above 102.41 on the upside, losses would be incurred on this spread. Now, you have to ask yourself, are these dollars of profits attractive? Well, the way to really measure that is to look not only at the absolute dollar levels of profit, but look at the dollars of profit in relation to the margin. The margin to put the trade on is $960. So a $440 profit divided by a $960 margin is a yield or a return on margin of 43%. And that's a 43% return in 29 days, in essentially a month. That's a very attractive return. But of course, it all depends on what transpires between now and 29 days from now. We are basically looking at a performance graph that is a time-lapse picture. It's a time-lapse picture because it shows us how this trade, this calendar spread, will perform as time goes by with each of these timelines, each of these performance curves, as well as the market moves. So we're looking at those two variables, and we're also looking at how much this trade will earn if there is a change in implied volatility. That's the Vega factor, and we can build that assumption on a volatility change into the volatility change here on the left side of the screen, so we can really see where the profits build and how much they build. Now, let me pause for a moment here, and let's see. I want to see if there are any questions here. All right. No questions so far. Definitely feel free to put questions into the chat window, and I will pull that up periodically and check and take a look at it. Okay, here is a question. Why was implied volatility projected to rise? Well, I'm simply using this as my first illustration that if you were of the opinion that implied volatility would rise, this trade structure and at-the-money calendar spread will benefit. It will benefit because the Vega factor is positive, and that Vega factor represents dollars of profit for each 1 percentage point increase of implied volatility. Now, if you say, why is IV projected to rise? Well, that's a whole other subject. I mean, each trader will look at the price and volatility chart and come to his own assessment, his own conclusion about whether implied volatility in his mind will go higher or lower. I don't want to get into that discussion because that's a whole discussion unto itself that relates to what's the level of the blue line in relation to the brown, what's the level of IV in relation to SV presently. Also, it relates to what is the current IV level of 24.6, how does that compare to the blue line in the past? All those sorts of things, because as options traders, you probably have heard that implied volatility tends to gravitate to its average or mean long-term level. And that is really one of the ways that options traders can attempt to acquire a trading advantage or a trading edge. Okay, what determines the strike price you choose? Well, when you're a volatility trader, you have to not only forecast what you think implied volatility is going to do, but you also have to have a forecast or an outlook for what the underlying is going to do. So the strike prices you choose are a function of what your forecast is for the underlying markets. When you choose an at-the-money calendar spread, you are basically making the assumption, you're making the forecast that the market is not going to move a whole lot in either direction. You don't want it to move a whole lot in either direction. You simply want time to go by and you want implied volatility to increase. And that's how you're going to make your profits. However, if you had a forecast for the underlying and you said to yourself, based on what's been happening here, I'm of the opinion that crude oil is going to decline in price, then you'd want to put on a different type of a calendar spread. You would want to do the following. One of the things you could do is still use July and August, but we're going to use puts now, and we're going to go below the markets. Since the current market is above 89, if we go to, let's say, the 86 put in July and sell that, and buy the 87 in August, we are putting on an out-of-the-money put calendar spread. This out-of-the-money put calendar spread has a slightly negative delta, a very, very slightly negative delta, -1 starting out. But as time goes on, and I'll change the colors to red, in 29 days, you can see that on the downside is where the larger profits grow on this particular trade. It's the type of a situation where you are choosing the strike prices below the market in order to accommodate a down move in the market. You still do have a positive Vega factor and you still have positive time decay, but you are biasing the trade a little bit to the downside. If instead of choosing the 86 calendar spread, I were to go all the way down to the 82 calendar spread with puts, you're going to find that now the position is biased more to the downside. We really are looking for a larger move down closer to the 82 level in order to see profits build on the trade. And the profits are rather modest in terms of positive time decay, but they build rather significantly when you factor in an assumption about a rise in implied volatility, if that's what you're also expecting. Then you can see the profits will grow quite nicely, especially in relation to the small margin of $868. Let's see. Bill says head stuck in equities, so it didn't compute that price and IV would move together. Well, sometimes in commodities, the price of the underlying does move in the same direction as implied volatility, but not always. Sometimes they go in opposite directions. As a matter of fact, if you were to look here, you could see that between December and February of 2012 and February of 2013, we did have them going in opposite directions. We had crude oil rallying and implied volatility going down. Right after that, we had crude oil going down in February to early March and implied volatility going up. So there are no hard and fast rules about whether there is a direct or an inverse or no correlation between implied volatility and market movement. It's one of the things that makes trading so challenging. Another trader might feel that, well, you know, I am of the opinion that crude oil is going to rally. So if I were to show you this graph, somebody might think this is the beginning of a move to the upside. And if they want to couple their opinion about market direction along with an assumption of implied volatility, there's a lot of things that that person could do. They could put on an out-of-the-money call calendar spread. So if they were to go to the 93 call and sell that and purchase the 93 call in August, so now that is an out-of-the-money call butterfly. That is bullish in orientation, but once again, it benefits from a rise in implied volatility, benefits from positive time decay. And so there is flexibility on what strike prices a person would choose. And I've only shown you simple calendar spreads using the same strike. As a matter of fact, if we look at, for example, let's say we were looking at earlier at a call calendar like the 96, that would be a, let's see, what do I have? I've got an extra option in there. Let me close that out and start over again. If we look at a bullishly oriented calendar spread at the 94 level, it looks like this. And I've chosen the 94 calls. You'll notice the open interest is quite large on both strikes in July and August. But interestingly enough, when you're dealing in calendar spreads, it doesn't matter whether you use puts or calls. It's only the strike price that matters. So instead of doing the 94 call butterfly, if we were to do the 94 put butterfly, you will find that the graphic analysis for that one is identical to the graphic analysis for the call butterfly. Going back and forth on the screens between them, and you can see it's the exact curve. So when it comes to choosing puts or calls, you simply want to use the options that have the greatest open interest, because that's how you can be assured you're going to have the best liquidity and the tightest bid and offer markets. There's good liquidity in virtually all of these crude oil options, whether it's puts or calls. But it is important to recognize that calendar spreads are a function of the strike price, and it doesn't really matter whether it's puts or calls that you're using. Okay, let's see here. Did I build a trade around where the price volatility is or where I expect the market to be? Do I favor forecasting the price or the volatility? Well, you want to build the trade around where you believe the market will be, whether it be 29 days in the future, maybe some other time period, depending on your trade horizon. You always have to build your trade based on what you expect is going to happen. And as far as do I favor forecasting price or volatility, you have to focus on both. You really can't isolate one and not worry about the other. You have to have an outlook that encompasses both your expectations for implied volatility and for price direction of the underlying. It's a function of both. So let's switch gears a little bit here, and let's talk about if you expect implied volatility were to decrease, how would you structure a trade for a decrease? Well, it's exactly the opposite of what we were doing. If you were neutral on the market, you would go to the at-the-money strike, essentially the, let's say, the 89 strike, and instead of selling the front month, you would buy it, and then you would sell a deferred month. So we're buying July, and we are selling August. And what that does, of course, is it flips the graph that we were looking at before on its head. Now we have negative time decay, we have negative theta, and we have negative vega. In other words, this trade loses with the passage of time, and it benefits if implied volatility decreases. It gets hurt if implied volatility increases. This type of a trade is a pure volatility trade, but unfortunately, the passage of time works against you. So I'm not a big proponent of doing reverse calendar spreads simply because your timing has to be very good on when you expect implied volatility is going to decrease in your favor, because the longer it takes for that to happen, the more you're going to lose from negative time decay, and the larger the move in volatility that you need to help bail you out. So if 29 days were to go by and the market really didn't move, we need the implied volatility to decrease by 5 percentage points in order to essentially break even on this trade. Now, a big market move to the downside or to the upside can bail you out because there is a slight concave upward shape to the performance curves. But I personally, when I am trying to anticipate or I am forecasting a decrease of implied volatility, I favor simply doing an at-the-money butterfly or an at-the-money iron condor trade, or a close-to-the-money iron condor trade, because those trades benefit from negative vega, but they have positive theta. I like to have trades with positive theta if at all possible, because otherwise the timing on the volatility change is much more important for you. Let's see here. Reverse calendar spreads will also hold a big margin also, correct? Well, no, reverse calendar spreads have very low margin. You'll notice the margin on this trade is $695. It's essentially a $700 margin trade. And it does collect a credit, so you have positive cash flow, but you do have negative theta. Now, as time goes by, you will find that the losses on the trade will cause the maintenance margin to increase beyond the $700 level. You can see that after 43 days, the maintenance margin is $1,100. But the initial margin is rather small on reverse calendars. The initial margin on the traditional regular calendar that we did it originally, where you're selling the front month and buying the deferred, the margin on that is simply the cost that it takes to put the trade on, the cost of the more expensive deferred month option reduced by the premium collected on the front month option. Now, I've only been showing you July versus August, but if you were to widen out this type of a spread and do July versus September, you're going to find that the vega factor becomes more significant. In this case, it's a negative vega factor because it's a reverse calendar, negative vega factor of 59 negative. And of course, if it was a regular calendar where you sell the front month and buy a deferred month, then the vega factor is positive. So you have a greater volatility impact when you widen out the time period between your short and long strikes. Okay, I see a question here. How about doing the reverse calendar after earnings on a stock like Apple or Google, a high-priced stock? Well, that's probably theoretically a reasonable thing to consider doing, because a reverse calendar will give you the concave upward performance curves that can benefit from market movement, and it will give you a negative vega factor that will benefit from a decline of implied volatility. The only thing is, with a stock like Apple or Google, the implied volatility will immediately decline when the earnings are announced. So timing is very important. If you wait too long to put it on, then the IV is already dropped, and you're not going to get the benefit of a negative vega factor if you don't put it on ahead of time. So you really would want to do the reverse calendar spread before the earnings are announced, and then hopefully be able to take it off after the earnings are announced and after the stock either makes a move in your favor or at least after implied volatility decreases in your favor. Okay, now I want to also introduce the concept of diagonalizing these spreads. let's say that you were looking for an increase in implied volatility, so you're going to do a calendar spread, but you're also looking for a move to the upside. I showed you could accomplish that by putting on an out-of-the-money, use an out-of-the-money strike with the calls, and you have a bullish bias with a positive vega. But if you wanted to be more aggressive and you wanted a larger vega factor and a larger theta factor, what you could do is instead structure the trade where in the deferred month you buy the close to the money strike. So that would be, for example, the 90 strike with a delta close to 50. And then you go with an out-of-the-money call, and you can choose the out-of-the-money call based on the deltas. So if you wanted a 13 delta positive trade, you sell the July 92 call. So this is a diagonal calendar spread with calls because it's selling the front month and buying the deferred, but it's using different strike prices. Now when you do your graphic analysis, you find that your theta will grow as the market moves higher, and your positive vega factor will also tend to grow with the passage of time. And you can get some very large profits in a short period of time if you are right about market direction. So we're biasing our market direction a little bit more with the diagonal calendar spread and still obtaining positive time decay and positive vega. Okay, let's see. Can I show how an at-the-money butterfly works so we can see a trade with negative vega and positive theta? Yes. All right, let's look at that. An at-the-money butterfly would be the following. If we are going to work, let's say, with July options, the body of the butterfly is close to the current price of the futures, so we would go with, let's say, the 90 strike. We'd sell 2 options there, and then we would purchase an out-of-the-money call, and let's go with the 94 call. So the 94 call is 4 points above the 90. Now we'll go 4 points below the 90 to the 86 call and buy that. So we're buying the wings 4 points away from the body, and when you look at the graphic analysis, you have positive theta and you have negative vega. So you do benefit when implied volatility drops, and that negative vega factor gets increasingly negative with the passage of time, and the theta gets increasingly positive with the passage of time. So this would be an example of an at-the-money call butterfly to take advantage of an anticipated neutral underlying market along with an anticipated decrease of implied volatility. And of course, if you wanted to, instead of doing this at-the-money butterfly and spend $830 to put it on, if you could do this very same trade and make it an iron butterfly, which means you would sell, instead of 2 of the at-the-money 90 calls, you would instead sell a single 90 call. You would also sell a single 90 put, so you'd be selling an at-the-money straddle, and then you would put your insurance in place, which is your out-of-the-money call at the 94 level, and then 4 points away on the put, the out-of-the-money put would be the 86 put. So this would be an iron butterfly that has the exact shaped performance curve as the one that we just looked at where we used all calls. It's the same position, but the difference is now you are collecting a huge credit. You're collecting over $3,000 of cash flow, and the margin on this trade, separate and apart or independent from the cash flow, is only $384. So you're always, in my opinion, better off doing the iron version of the butterfly rather than doing the other version, all with calls or all with puts. Okay, let's see here. Let me close this. And let me also show you now if you were bearish on the market and you anticipated an increase in implied volatility, you would want to do the following. You could go to the month of August, purchase the at-the-money, let's say the 90 put. In July, you would look at an option that has a smaller delta, let's say the 87 put with a 31 delta, and we'd sell that. So now we have a bearishly oriented diagonal calendar put spread with positive time decay and positive vega. Let's see what it looks like. You can see that this looks nice because the passage of time at the current level generates profits. Profits are also generated as the market moves lower and as time goes by. So when you have a trade of this nature, the only thing you have to worry about is, well, two things. You have to worry about a rally in the market, and you have to worry about implied volatility going the wrong way. If implied volatility decreases, the trade loses money. So let's make that assumption. Let's say the market rallies, and as it rallies, implied volatility goes down, which is going to hurt us. If it goes down 2 percentage points, the trade loses $490 at this level, $92.70. The trade will still make money if it decreases in price and implied volatility goes against us, because the vega factor doesn't hurt us that much. Our negative deltas and the positive time decay will still generate profits on the downside. So it's really a combination of a directional biased position along with a volatility bias that may or may not help us, depending on whether it goes in the direction that we wish. One of the things you really would want to do when you're putting possible trades in the matrix is to look at the relationship between vega and theta that you can see here near the bottom of the screen, the relationship of vega to theta. Because what that's telling us is when you put this trade on right now, since vega is 41 and theta is essentially 5, that's a ratio of vega to theta of about 8-to-1. And what that really is telling us is if you're wrong about implied volatility, it's going to take 8 days of positive time decay to compensate for the loss that you would see based on a 1 percentage point decrease of implied volatility. If implied volatility decreased, which is unfavorable by 2 percentage points, we lose about $80-some, and it's going to take us 16 days to make that up. Now, if we look forward 29 days into the future, you'll notice that the ratio of vega to theta is different. Here it's a ratio of about 5-to-1. It started off here with a ratio of 8-to-1, 41-to-5. After 29 days, the ratio is 52-to-11. That's about 5-to-1. So we're in a dynamic environment. The passage of time as well as movement in the market affects what that ratio of vega to theta is. But OptionVue is an excellent tool that allows you to see how those relationships change. All right. I've been showing you trades, for the most part, that are looking for an IV increase. And then I showed you trades for an IV decrease with an at-the-money reverse calendar spread and with an at-the-money butterfly or iron butterfly. There's another way of doing a bearishly oriented trade, and that would be the reverse diagonal spread. So let's take a look at that. If we structure a trade where we go to August and we sell an at-the-money put, that would be like the 89.5 put. 89.5 put in August. We sell that. It has a delta of 36. Now, if we purchase an out-of-the-money 86 put, what do we have? We have a reverse diagonal calendar put spread, and it is bullish. It's 9 deltas bullish, and a reverse diagonal calendar put spread has negative vega. Any reverse calendar spreads or diagonal calendar spreads will always have negative vega, but they will also have negative theta. They always have negative theta until you get a sufficient enough move to the upside, and then your theta can start to turn positive. So you need the market to move in the direction that you wish. But just as I showed you before, I prefer, instead of doing these reverse calendar spreads or reverse diagonal calendar spreads, I would much prefer to do a out-of-the-money butterfly where the target that we're looking for is above the market. So if the market is at 89 and we are expecting the market to move higher, why not sell the 93 call? Why not purchase the 89 call? I should say purchase the 89 call, sell 2 of the 93s, because that's where we think the market's headed. That's 4 points wide. Now we go 4 points above this to the 97 call. And what we've done is we've put in place an out-of-the-money call butterfly that benefits with the market moving higher and benefits from a decrease in volatility. I like this trade better because we're getting positive time decay while we're waiting for the market to rally. When you compare that to this trade here, you can see that you can still generate nice profits, let's say at 95.90. Well, here's the difference. This reverse calendar, diagonal calendar, makes huge profits with a big rally. The out-of-the-money call butterfly gives you nice profits only if it stays within the range that you've sort of targeted. We could put this butterfly using strike prices further away if we wish, but this one is targeting a range in the neighborhood of, like, say, 91.10 to 92.70. That's where the optimal profits are. On the reverse diagonal put spread, anything above 92.70 is where you're going to really start to make big money. So that's why I say when you do these trades, you must have in mind what your forecast is for the underlying as well as what your forecast is for implied volatility. Both of these trades benefit from IV going down, but one of them benefits greatly with a big move up. The other one benefits greatly only if the market makes a modest move up. That's the beauty of options, is you have all of this flexibility on how you structure your positions. So let's get rid of this. What if we were to, in the month of August, not sell the at-the-money put, but what if we sell the out-of-the-money 93 puts? And then we go into July and we purchase the, let's say, the 89 puts. Now let's take a look at this graph. We actually need the same thing. We need the market to rally in order to make money. And you can see that all the way up to $43 days of time, here is our break even, 91.64. We need the market to move above 91.64 in 43 days in order to start to make a profit. Anything below that is going to cause losses, and those losses can be rather severe. So when you start playing around with different strike prices, you can start to see how you can make the trade look more attractive. So if you go with an out-of-the-money 85 put with a 25 delta, purchase an 81 put in July, so now you're 13 deltas long. Now look at this. Now you're in the positive time decay zone. So even if the market is unchanged as time goes by, you will make a profit, and you will benefit quite nicely from a decrease in implied volatility. So the bottom line on this is you want to consider out of the money, reverse diagonal calendar put spreads if you are bullish on the market and if you are looking for implied volatility to decline. Likewise, or quite the opposite, if you are looking for an increase in implied volatility and you want to benefit from a decline in the market, then you do the opposite. You do the opposite with calls, or you can do it with puts. You would be selling the July and buying the August. Now you've got a negative bias with an increase of vega, a positive vega. These strike prices would not be ideal because you can see starting off you have negative beta and passage of time works against you. So that's why when you're looking for a bearish position, I would suggest that you sell the close to the money July, would be like the, let's say the 90 call with a 54 delta, and then you buy an out of the money August call with maybe the 94, do it with the calls, and then you do have your negative delta. Your positive vega is quite small, however. It really doesn't give you a big vega factor, but it does give you a delta bias. So for an increase of implied volatility, if that's the main objective, but you also want a bearish position, then you're better off going into the deferred month and buying the close to the money call. That's a 56 delta, and you would want to sell, for example, the 93 delta, the out of the money call. So you've got a diagonal calendar call spread with a positive delta bias, and you will earn money as the market rallies. Okay. The other thing I wanted to mention about these spreads is you'll notice I'm always doing them in pairs in the sense that for every short call, you've got a long call. For every short put, you've got a long put. I do not like the idea of ratioing these spreads because when you ratio these types of positions, and by that what I mean, if you sell, let's say, 2 of the 95 calls, out of the money calls with 26 deltas, and then if you buy an at-the-money August call, that would be a ratioed diagonal calendar call spread. And what that does is the following. It means that you will earn positive time decay, and this is a trade that would be good for a negative volatility outlook. But the fact is you have an extra short uncovered or naked call, and that's why the losses on this trade can be very large on the upside. And so I stay away from ratioed positions. Basically, I stay away from uncovered short positions because as a retail options trader, you really want to have your bases covered, and you don't want to have unpleasant surprises where a large move in the market can cause very, very large losses in a short period of time. Now, the other thing about these types of volatility trades is these can be, in my opinion, the core position that you would use to start with, and then you can modify it as the market moves. So here's what I mean by that. Let's say that you had the following position. Let's say that you were long the at-the-money August call, and you were short the 93 call. So you were bullishly oriented with a positive vega factor. And let's say that the market moves against you and it drops down to 87.90. That's about a 160-point move in crude oil against you. You can see that if it does that right away, you lose $320. If it does it in 2 weeks, it's about the same. All of these lines sort of converge. So you've got up to a month to hopefully have the market rally, but if it doesn't and it stalls out and goes down, you have a choice. You can close your position and take your loss, or if you were of the opinion that, you know what, now this market, in my view, is not bullish, it's really probably more in a trading range, or maybe it's going to turn bearish, you can change this trade. And you'll notice here's what you would need to do. You'll see that the delta on this position at this level is 27.94, essentially 28 deltas long. So you have to say to yourself, I want to get approximately 30 negative deltas. How do I get 30 negative deltas? Well, there's many ways of doing it, but one of the ways of doing it is to do a credit call spread, One of the ways of getting a credit call spread is to sell to close your August 90 call, because obviously that has not been helping you. It's been going against you. You would sell that, and what you would then do is purchase, let's say, the 95 call with a 32 delta here. So when you sell the 90 call and buy the 95 call, that is a credit call spread, a bear call spread. And when you look at that in conjunction with the trade that you had, here's what you had before, but now you've changed the dynamics. Now you are 2 deltas negative, and you will have a little bit of positive time decay, so that as time goes by, the trade will tend to make some money. You've reduced your downside exposure, and you've actually given yourself the opportunity to earn profits on the upside if time goes by. Okay, I'm getting an hourglass on my trade here. Let's see, there we go. So that's one thing you could do. Another thing you could do, if you wanted, is you could, to obtain negative deltas, as I say, you would do a credit call spread. So you can do a credit call spread in the month of July. Okay, something's happening to my matrix here. I'm not quite sure why it did that. There we go. All right, a credit call spread. So if we sell the 89 call in July and buy to close the 93 call in July, what do we have then? Now we've got this trade. We're 2 deltas short, positive time decay, positive vega. The passage of time leads to profits. So these calendar spreads and reverse calendar spreads do lend themselves to adjustment if you desire to do so. But first and foremost, you want to look at these trades as volatility type trades that you can, if you wish, provide a delta bias to, or you can make them delta neutral with the at-the-money strike or by using at-the-money calendar spreads. Now, the only thing that I didn't really cover here is, what if you wanted to do a volatility trade that had positive vega, but it was neutral on the market, and you wanted to cover both sides of the market? What a lot of people would consider doing is they would say, I'm going to buy the at-the-money straddle, I'm going to buy the 90 call, and I'm going to buy the 90 put. The at-the-money straddle obviously has positive vega, but look at the negative theta. The negative theta, it loses $56 a day, but it certainly benefits if the market rallies or the market declines. So this is a situation where you've got to be awfully good on the timing of the move and awfully good on your guess of implied volatility, because $280 some is a lot of money to lose if you're wrong about implied volatility. So what you can then do is go into the next month out and sell an out-of-the-money call. I'm just going to choose the 95 call with a 32 delta, and I'll choose the 85 put with a 25 delta. So we're selling an out-of-the-money strangle in the month of August, which will counteract to a great degree our long July position. Now, what does this look like? This looks a lot like the at-the-money reverse calendar spread that we were looking at before. It looks a lot like an at-the-money reverse calendar spread, but here we're using strangles and straddles instead. So why complicate things with 4 options when instead you can simply go to the at-the-money strike with puts or calls? Let's go down to the puts here and purchase the 85.5 put, sell the 85.5 in the next month out, and then you've got a very, very similar looking graph. Very similar Greek variables also. So you want to keep things as simple as possible. Use 2 options instead of 4 options. Okay, any other questions on this? All right, well, let me also let you folks know that I do have a website. I put it in the chat window, theaceprogram.com, and let's see here. Let me put it in there again, copy, there we go. Theaceprogram.com, and on that website you will find that I have recorded webinars. There's about 25 of them, similar to the one we just did today, on a variety of topics, and they're all free. I also have other material that's available for purchase in the way of webinars, books and ebooks and DVDs. So check it out. And if you have any questions about today's webinar, feel free to send me an email. My email address is, I put it in the chat window as well, owl@west.net. owl@west.net. Oh, yes, and thank you, Jim. I see that you put in the note that you can always see the information about our upcoming webinars for the week and the full calendar and the link to all recorded webinars on the front page of the OptionVue website, OptionVue.com. All right, thanks very much, everybody. Hope you got some value out of this, and look forward to talking with you in the future.